Hi guys, thanks for tuning in to another episode of Nuggets News. Today we welcome a special guest, and that's Hugh, the founder of Nexus Mutual. We're going to be talking about financial derivatives, insurance, doing this through the decentralized model. I'm really looking forward to this. I think we're going to go into some fascinating topics. So thanks for joining us today, Hugh.
Yeah, great to be here. Thanks, Alex.
I mean, where do we even start? I've often thought that the world of insurance is next. It's a perfect application for blockchain and everything that's going on in the DeFi space. I know you're doing a lot of interaction there, but maybe start off with a really basic explanation of how insurance works in the traditional world and what led you guys to go down this path.
It's I don't know. It's really fascinating. I'm an insurance person by background. I've been doing insurance for quite a while. Stepping right back, insurance is actually just about financially coordinating a bunch of people, pooling money together, and then deciding in some way how to distribute a claim payment. And really, the main intention is just to make the group of people or society more resilient to risk.
Yes.
So you kind of pool the risk between a group of people, and that's fundamentally all it is. Now we've kind of moved away from this kind of mutual model of doing things, which is kind of how it used to start hundreds and thousands of years ago, and we've kind of gone to the shareholder model of doing stuff, which makes a lot of sense, mainly because it's kind of the most efficient way we have right now of connecting capital to people. So you kind of use the shareholders to connect the capital markets to the risk, where it's the people that need cover.
Yeah.
I guess, but at a very high level, our premise is that we now have a pretty cool financial coordination tool on the blockchain, on Ethereum, and you can actually use that to create incentives to bring people together without the need for that shareholder model or shareholder insurance company. So that's essentially what we're trying to do.
Yeah, and I think for people at home, I know the first questions that come to mind for me were, how do we do the settlement and the dispute process and all those grey areas in between? So where do you want to start there? Should we talk about oracles and how we get the real data from the real world into the blockchain?
Yeah, so we decided pretty early on that we wanted to have, there's kind of two main approaches. You can have a voting structure of some description or a kind of oracle-driven approach. We decided pretty early on we wanted a voting structure, primarily because we didn't want to be limited by what data feeds we could get to therefore tell us which type of covers we want constructed. And we wanted to be a bit more flexible than that. So we went with the voting approach, which kind of allows us to get any type of information on. It obviously there are pros and cons with this approach. It's a bit more complicated, and there is a bit more grey. But I guess the other thing is claim payouts in the insurance world are inherently grey. There's no always black and white definition here. And if you create a black and white definition, then you can end up paying the wrong people, or you can end up paying not enough to the right people. And that happens with any solution. So we just wanted to have a voting structure that could actually more offer any product. You can put kind of a lot of flexibility in with that, and so you can actually compete with the regular insurance companies in the world if you have that pace.
And who's voting at this stage? Is this the full decentralized model where all token holders will have a say? And if that is the case, if I'm voting on whether or not something happens in the real world, their house gets burnt down, how do I know, without all the knowledge, whether or not the fire was the cause and whether to pay them out?
Yeah, no, good point. I mean, we've got so basically it's the members of the mutual that are voting, so it's the token holders, and there's a staking process involved in that.
Yeah.
And one of the restrictions that we do have right now is that the decision to make a claim has to be publicly available. So one of the things we're starting with is smart contract cover, which is if there's a bug or hack in the smart contracts, then we pay a claim. And so by looking at the on-chain transactions, you can see exactly what happened. So there's kind of a verifiable data source there.
Yeah.
So yeah, that is a restriction right now, but also when we grow and compete, we're expecting that to kind of scale down to more localized teams that would assess claims and things like that. But that requires scale, and that's a bit further down the path.
Yeah, that was my next question. And I guess, does that centralize things? But ultimately, if we have health professionals deciding which health claims should get made, You know what I mean? Like the people are going to complain, oh, well, that's centralized, but is there a reputation system further down the roadmap and that type of thing?
Well, I mean, there's an incentive system for the claims assessment, and if you're not kind of good at doing that, then you're not going to get rewarded, and it's not going to be worth your time. So we're hoping the majority of this is self-selection.
Yeah.
And look, there's always going to be degrees of centralization or decentralization on this stuff. Like, you're not going to have 1,000 people voting on whether someone's medical claim is valid. It just doesn't make any sense in any realm, really. So we have to. There are definitely trade-offs here, and we're just kind of going for that full mutual model where it's the members that have the say on what goes on.
So I know, like a lot of projects, they say decentralized, but then people start to critique and say, well, you're not 100% decentralized. But at the end of the day, if you're cutting out all the middlemen in the traditional world, I guess you're just making a more decentralized, better product, more efficient.
Yeah, that's right. I mean, we're taking a similar approach. We realized very early on that it was going to be very technically challenging to be fully decentralized, and that we could spend 5 years doing a great research project and come out with something and probably miss the mark. So we prefer to kind of release something and then iterate on it and then decentralize further over time. So yeah, we do have some centralized elements to it, but with the aim of kind of removing those as many points as possible.
Yeah, and I guess for people at home, you mentioned that there's going to be tokens at stake. Ethereum's also moving to proof of stake, and they're tinkering with what their penalties are going to be for doing the wrong thing. So they're talking about, slashing a percentage or maybe even all of your tokens. Is there an easy way for you to explain, is that the same as what Ethereum are trying to do with your model, or what are the subtle differences?
Yeah, we have a few staking mechanisms, but one of the most, I guess probably the biggest one is when you do risk assessment. So basically kind of like an underwriting process in insurance. So deciding which smart contracts are secure. So the idea is that the members of the mutual stake the native token against smart contracts that they think are secure, and the more people that stake, the lower the price for other people to buy the cover. And so then when there's a claim, or if there's a claim, then the stakes get burned. So there's a reward mechanism, and then if there's a claim, it gets burned. So it's very kind of specific. If there's no claim, no burning. So yeah, it's a bit. It's kind of a bit easier to tell if you've done a good job there, rather than with proof of stake, are you offline, or are you being malicious, or how does that kind of work?
And does this become, if I was really good at making a lot of decisions, the rewards are fairly high to the point where it could almost turn it into a little business? Like, I know a lot of projects are experimenting with what's the right percentage to reward people for the work that they're doing.
Yeah, definitely. That's our aim. Actually, just stepping way back, one of the things I really like about this technology is that it opens up jobs for people that may not be able to access them in different parts of the world. Like, you can kind of do this from anywhere, and so that's the idea, and that's the goal. It's the rewards on the risk assessment are definitely linked to how many people buy the cover. So you kind of become like a distributor. It's not like a fixed 10% a year or whatever. It's definitely kind of linked to the actual outcome.
So is there a preferred example that you like to give to people? I know Vitalik was talking about, if you've got cyclone insurance and there's a cyclone, the oracles or the voters confirm that the wind conditions, the temperature, the smart contract automatically pays out all these people. Is that, I guess, how it works in a nutshell?
Yeah. Basically, generally, one of the big use cases we've got right now is people participating in DeFi. They lock up money in lending protocols or Uniswap or whatever to earn some interest, and then they come to us and buy some cover in case there's a hack of those smart contracts and they lose the funds. And so if that was to happen, say Compound went down, for example, then they'd submit a claim and it'd go to the voting pool, and the voting process resolves, and then they get paid. That's basically how it works.
So you're insuring smart contracts in the digital world as well as insuring real things in the real world.
Yeah, so we're definitely just starting with smart contract cover and crypto native risks, with the plan to get to more regular products in the future. The idea, like, mutuals actually work really well when they start community based, and so then they can get some scale, and also there's no actual no real coverage you can get from the regular insurance markets for this stuff right now. We're the only real option. So I mean that's good for us, but just in general, if we're building a parallel financial economy, every economy needs insurance of some description to make it successful. It's just underlying financial infrastructure. And so that's kind of what we're trying to be for the crypto native world. So
out of interest, if a lot of these DeFi projects are offering say 10% a year, what would my insurance costs? 1% or 2%? And when you take into account the actual risk, would you do that? I guess water's got to find its level at some stage, but how does that all work at the moment?
Yeah, so most of the big DeFi contracts are at our kind of minimum pricing level, which is 1.3% per year. Yes. So the economics work quite well for if you can earn 10%, or it's currently about 6 or 7 or something, but it works quite well from that perspective.
Yeah. And was I reading that you guys are considering, with all the pooled funds, also lending them out to earn some interest yourselves? And in that situation, if you're insuring that contract, it doesn't work.
Okay. Yeah. So basically, insurance companies make a whole bunch of their money by just investing the float or the assets that they have, and probably half their money or something like that.
Yeah.
And so we're currently not doing that, but we definitely want to do it in the future. We just have to wait for the right options to appear. If we were to kind of put our money in compound when we're covering compound, then if that happens, then we've got a really big problem. So we don't want to do that. Yeah. However, there are kind of two big options that we see right now on the soon short-term horizon are the DAI savings rate with Maker, and also staking and proof of stake with Ethereum 2.0 when that goes live. And we see those as very good type of low interest bearing, low risk type returns, which is what we need to make it work.
And are you familiar with synthetics? And is that another one where you consider minting earning rewards and whatnot?
Potentially. I think we're more likely to offer cover on synthetics. We basically want to offer cover on synthetics because lots of people want it because they upgrade their contracts quite regularly.
Yes.
But that's also a challenge from our product point of view to make sure that they don't introduce malicious code stuff and claim and things. So we're definitely working out how to do that, but it's on the horizon.
And there's a lot of similarities there from another point of view, that they've got all their funds pooled for traders and trying to hedge risk. In a way, I guess there's a bit of overlap with what you guys are doing, that model.
Yeah, exactly. I think there's a whole bunch of there's similarities between things like prediction markets, derivatives, insurance. They're kind of very closely related. There's obviously a lot of it's about hedging risk. It can also be about leveraging risk, but it can be about hedging risk as well. And different kind of tools work better for different scenarios and things like that. So I just in general, I think they're very complementary type things, and they make a lot of sense to kind of work together in a lot of ways.
So are you guys doing some work with Olga, or is that prediction markets, again, just a bit of an overlap rather than competition? And correct me if I'm wrong, but that model is one trader on the other side of that bet changing those odds. Are there also prediction markets out there that are using the pooled model?
Not as far as I'm aware.
Yeah.
So, I think the main difference between prediction markets and insurance pools, just in general, the fact that you've got under collateralization on the insurance pools and full collateralization on the prediction market. So the insurance pool should be much more capital efficient and be able to offer better prices for extreme events, so ones that are very unlikely to happen. But the prediction markets are very good when you've got a 50-50 or type outcome, and it's more flexible. You can release a product really quickly and stuff like that. So I think they're definitely complementary, but insurance is more about managing those extreme events like catastrophic type stuff, and that's where prediction markets struggle a bit because you have to fully collateralize.
Yeah, and I guess just the law of large numbers, as you grow, you don't want to get a 1 in a million event early on, or if you have 100 different markets, it doesn't matter if you get one because they're not going to happen in other markets.
Yeah, it's definitely the diversification of risk. That's what insurance is all about.
Yeah.
And that's why it can work. So if you've got a certain amount of capital in your pool, you can cover many, many times that in risk. But for a prediction market, you kind of need 1-to-1 because you kind of have like a two-sided market for each risk, and then you need to fully collateralize. So I haven't seen any prediction markets with a pooling approach. Maybe that's on the horizon. I don't know. But that would be closer to a kind of insurance type structure.
Yeah. I guess changing gears a little bit, I want to talk about the financial crisis, because I know a lot of things that are happening on Ethereum and DeFi, they're starting to say, well, if we had all these markets and we knew the bonds and the price and the risk, blockchain would give it all more transparency and it wouldn't happen. We'd know who owned what. Are you guys, is that longer term on the roadmap about doing this kind of thing, financial derivatives? And that world is getting crazy again at the moment.
Yeah, I'm not necessarily on the roadmap, perhaps, but I guess it could be. But I think just in general, like the transparency is going to help massively in that type of world. Like the other side of it is that we're building Lego block on Lego block on Lego block, and if one of them goes down, then a whole lot of things go down.
Yeah.
So I think there is systemic risk, and it's just perhaps taking a bit of a different form. And I think we all need to be very aware of that, of what we're doing. And I mean, we're kind of running before we can walk on a whole bunch of this stuff right now, but it is still relatively small. And if something happens, it would be relatively contained. Obviously not good for the people that are in there. But I guess in general, like we're hoping to be at least one subtraction on the risk levels that the whole space is accumulating. And I think for this space to kind of get serious, kind of grow up, get a bit more financial nous behind it. I mean, we got to have that fast experimentation, but at some point we also have to put the controls in to make sure that it's working okay and it's all robust. And so I think we're progressing along that path, and hopefully nothing massive blows up before we get there.
Yeah. So I guess what sort of things are you insuring at the moment? Because I know just even the hodling of Bitcoin, custody and insurance is becoming a big thing. Have you got that sort of demand at the moment? You mentioned people want for synthetics. Have you done 100 smart contracts already? Did I read recently? Or
yeah, so we've got over 100 people buying smart contract cover. They're probably covering about 20 or so different contracts. So it's going really well. But I guess we're just starting with the one product as in covering the hack or bug risk of smart contracts on Ethereum.
Yeah.
But we're definitely looking to expand into different crypto native risks, especially where the insurance companies aren't comfortable playing, because there's a big knowledge gap, and we can help out with that. There's lots of stuff in there that we could be looking at.
I think it's a tremendous opportunity. So many people ask us about the compound, and they want to put that money in there in a low interest rate environment, but they're worried about the risk. So I think a lot of people would be happy to pay that 1% insurance.
Yeah, no, that's where we've seen most of our demand. So yeah, it's definitely, people get intrigued when you say you can earn 10% or whatever it is on your money, if they don't immediately think you're trying to scam them or something. But I think the savvy people will go, okay, fine, but what's the risk I'm taking on? And I think right now we've got a bunch of crypto people that are fine with kind of gambling, which is okay, that's fine, that's good as well. But I think to kind of step up to the more serious businesses and get a bit more expansion into I guess more regular people, then we're going to need more kind of robust systems, and I guess hopefully we're part of that.
Yeah, I always tell people 5 or 10% a month is the pyramid scheme. 5 or 10% a year is DeFi, and even that's I guess risky and very small in terms of the number of participants at the moment. So next thing I want to get to was the token. So NXM is your token for the staking, and people always say, why do you need a token? Why couldn't you use ETH or whatnot? So what are all the utilities there?
Yeah, so basically, the token represents your membership rights of the mutual, and so you can use that to buy cover, stake with risk assessment, staking claims assessment, and voting governance. Also, if the members were to kind of vote to shut the whole thing down, then it's kind of the kind of proportional ownership of the whole mutual. I guess one other interesting thing is it does actually have, we're a kind of DAO, but we're wrapped in a legal entity. So the token does have legal rights in the UK, and you join, if you join the mutual, the DAO as a member, then you actually join the company in the UK as a kind of membership organisation. And so we have a pool of assets which the members jointly own, and essentially the token's the way of governing what to do with those assets in whatever shape or form, payout claims, governance, etc.
So does that mean it won't be freely traded all across exchanges and that?
Well, potentially, I don't know. I mean, the thing is, there's a whitelist approach, and the token can only be owned by the members, which is very similar to how like security tokens and those things work. So right now, those types of things aren't heavily traded on exchanges, but that's potentially coming as well. So, yeah, I mean, I guess the other aspect of it is we are running a bonding curve, so you can buy and sell directly with the application.
Okay. Yeah, it's one that I'm definitely interested in. So I will look into it more in terms of the token. I always love when there's something in a new industry, and at the moment you guys are the only ones in insurance. So yeah, I'm definitely looking into that more. Is there anything else we haven't touched on today that you think's interesting to talk about?
No, not particularly. I think we kind of covered a whole bunch of different stuff. I mean, just in general, I love the fact that DeFi is just trying to build this parallel financial economy for when people get disenfranchised or can't get access from the regular systems. And so, yeah, I'm just really excited to be kind of part of this space and hopefully helping out real people down the road.
Yeah, I've always been a Bitcoiner, but I'm a massive Ethereum bull since I first read about it. And it was hard watching all these other projects and promises spring up. And I owned a lot of the decentralized ones, and they're really coming to the forefront in the past 6 to 12 months. Like you said, the Lego bricks and building on top of each other. It's so great to see. So do you have any little favorite projects, or maybe ones that are a little bit more hidden that are doing interesting things?
I love just the smaller ones, like things like Pull Together or RDI or something like that. They're just doing some really basic stuff as you'd think, but it's actually kind of building this really easy to use financial primitive, if you want to call it that, that could be fundamentally like really, really useful that you can't do easily at all in the current financial world. And so those are the things that fascinate me. I kind of think that, we've got this existing financial world. We started by building the things that we know exist in Ethereum because we know that they kind of work. So we're trying to just copy the model and bring it across. But the really interesting things to me is that what are the new things that you can do that you couldn't really do before? And I think we're starting to see more and more of those things come about. And I kind of think a couple of those really working is going to lead to that's what's potentially going to get us the traction with real people, because it's something fundamentally new rather than just it's an alternative.
Are there any examples, super futuristic stuff that you've thought about of AI starting to ensure all sorts of bizarre things, or anything real far off that you've thought about?
Well, maybe not that level, but I mean, but the other thing is, right, if you have blockchain or Ethereum as the kind of layer of this stuff, that kind of gives you the fundamental thing in an insurance world that it gives you is that open API architecture. So you've kind of built an insurance company that is fully open that anyone can integrate with, and that's like that's a massive step forward over the current legacy insurers. And if anyone can build like AI or connected to IoT devices and stuff like that, which is what the regular insurance industry is doing a lot of, but they're doing it very manually because that's the infrastructure they're building with.
Yeah.
But if we can do it in an automated fashion and provide that solid kind of clear data layer with clear data structures and stuff that you can interact with, I think that has the potential to be quite huge. But it's got a road to go, obviously. But to me, that's where we're headed.
Yeah, I guess the final question I had. We recently chatted to some guys that are doing securities on the XRP ledger. We've had a few projects that are building on EOS. So what's the reason for you guys when people say Ethereum's too slow and it can't scale? Is it just because of the sheer number of developers and interaction we see?
the security, one of the things that was critical for us is being able to have no one custodying the assets of the mutual. That was fundamental to what we wanted to achieve. In my opinion, the only security settings that can handle that right now are Ethereum. Well, Bitcoin could, but it's too hard to build it. So that was basically the only choice. I mean, in terms of scalability, the scalability of Ethereum right now is absolutely fine for what we're doing. We're basically doing high value, lower numbers of transactions. So that's fine, but obviously it's going to become an issue at some point. But I'm just trusting the whole pile of really, really smart people that are working on this stuff to figure it out. And I'm sure they will.
Absolutely. We've already seen, I'm sure you guys could even go to a state channel or something if you had to layer 2 as well. So there's already solutions there.
Yeah, exactly. Optimistic rollups or whatever you want to call it. There's a whole bunch of options there. So I don't know what the exact solution is going to be now. Right now, it's working fine, but there's definitely stuff coming that we can transition to if we need to.
Awesome. That's relatively short, but I think we touched on everything I wanted to, Hugh, and I think this is a really interesting little project. So thanks so much for joining us today.
Well, thank you. Great to be on. Cheers.
Thanks, guys.